Hi there, it's Bill with Smart Trades, and it's September 10th, Friday, around 10:10 a.m. Pacific time. And today I've got quite a few charts to look at, so I'm going to speed read through some of them for you, and hopefully we'll get a little bit of an overview here of the various markets and situations that I'm looking at. Anyway, right off the top, here's my long-standing perspective on the S&P. And all I did here is draw two parallel exact cloned trend lines, one from the bottom of the July low up to the top of what I've got labeled as A. And I cloned that and brought it over to the bottom of B. Now, that basically terminates in early October around the 1157 area, basis the S&P cash. We shall see how it goes. The market so far is tracking pretty nicely following this path. Certainly doesn't have to reach there exactly, but keep in mind, I mean, the basic idea behind Elliott and just this kind of analysis is that we're looking for two symmetrical swings, and exact symmetry would put us up around 1157 on the S&P cash in the first week in October. So we'll see how that goes. Keep in mind that the market should swing either side of this ideal trend line. It's not going to go up there exactly. You're going to have some ups and downs along the way. But 1157, let's call it October 5th. And that's interesting because that's also the area of the secondary high back in 87. I'm not going to get into the 87 situation too much right now because I do have a lot to cover. Also, what will break this count is a drop below the B wave here. That price is around 1039 basis the S&P, and basis the Dow. A drop below 9937 negates this count and breaks this this scenario. Also, if we were to see sharp, impulsive declines to the downside, that would be a red flag as well. Here we have the spiders. As you can see, I've talked about this gap before. You really can't see it on the S&P so clearly because of the issues with the way they calculate the opening. Again, we've got a rally up into early October, a little over 116 basis the spiders, and then we should see a sharp a leg down if indeed my count is correct. Now here's the S&P cash, and here's the various scenarios. We're looking obviously way ahead, so take this with a grain of salt. But just to give you an idea, some folks think I'm bullish. I don't really see it that way. I'm market neutral, or I try to be, so that I have an open mind. The most likely scenario in Elliott terms is that you have equal legs, A and C are equal. That's where we come up with the 1157 target to the upside. And similarly, if we have two equal legs down from that 1157, assuming that indeed that becomes the high, the first target would be just under 950, about 946 to be exact. Now, there's nothing that says that the market can't extend, that we can't have a more serious decline, and perhaps even have an October meltdown. So the next areas to watch are around 820, and if we really, if the market really goes off a cliff, the 614, 615 level would be the area to look at if we had a total meltdown and a crash. Now those are not inconsistent with the basic concept of this count, but I think that the lower numbers are less likely. And there's more evidence to that too. This is the S&P cash, and we're going back here to 1997. And I want to bring your attention to these various swings. We have swing lows right around that 946 level, 950 level, basis the S&P cash. We've got swing lows in 98, 2001, swing highs in 2002, and you can see again congestions just above and just below that area. Back on the decline, the 08, 09 bottom. You can see here we had a series of tests of that area from below, which failed, and then obviously we surged through there. That area again, 940, 950. That's also a 50% retracement of the entire move off of the 2009 lows. So, we're not going to decide right now that it's going to stop there, but I think it's the most likely stopping point for a correction. And, it just fits on a whole variety of levels. The market remembers those old levels. I think we should at least get a bounce if we do indeed go down that low. But as always, we're going to take this one step at a time. We're not going to decide the market's going to stop there or even get there. We'll just see how it goes. But 950 an area to keep in mind if indeed we start getting a crash into October. Here's the short-term count on the S&P. I've got actually, I think we've got a little bit of a mess up here, and there's a whole a variety of possible counts. And this is one of my favorite scenarios, is that we're working on an impulse up and we're not quite done. This correction, this sideways pattern, which has both three-wave patterns up and down, could be a triangle. It's possible it could be an expanded flat, in which case we could have a sharp move down below the 1090 area before we move back up. And it's possible that we're carving out a fifth wave now, in which case a larger correction, a correction of this entire rally off of the late August lows, may be in the cards. At this point, I don't think it's clear which of these patterns is working. I would like to go over, though, a count that I think is not valid. I think I've seen this on the net. I think this is a bad count because it breaks some very basic Elliott rules. And this is basically the last gasp of the bearish camp, saying that we're still in a wave 2 rally here and that we're about ready to crash. Now, I agree that we're probably going to go down. Again, all the counts that I've shown in the prior three screens here are all pointing down, as is this divergence in copper. However, just noting copper here, copper has already taken out the August high. I think that still is bearish for the market, bullish for the market, and I think that higher prices are still likely until we get a more severe downturn in breadth and various bellwethers. But as far as this count goes, first and foremost, the relationship of A to C. Sorry, I don't have the C wave labeled here. I'm just showing you the 5 up. Already we've gone beyond the 2.62 times A relationship, and that's an unusually long C wave. And what you want to see here again, I mean, the most likely relationship is equality. So the extent of this rally and the second leg up is really too far, in my opinion, to make it likely that this is a C wave. Secondly, the folks that are counting this as a C wave are counting it as a diagonal triangle, but they're counting the first leg up as a 5-wave structure. And Elliott wave 101 says that diagonal triangles need to be, have 3-leg patterns in each of the 5 legs. In other words, it's a 3, 3, 3, 3, 3 pattern. And indeed, this is clearly 5 up. And then you have these, 3-wave patterns up, which again I think are better counted as part of a larger correction, perhaps an expanded flat or a triangle. Is this count possible? I suppose it is. You could break it down somewhat differently and call this rally up here an ABC, but the relationship between the first leg up and these subsequent waves to the upside just doesn't fit with the right look for a diagonal triangle. So I don't think this count is correct. Now, speaking of diagonal triangles, gold is starting to show pretty good form here, and it's possibly has already peaked. You can see here, this is a good example of how a diagonal triangle should look, in that you've got 1, 2, 3 up in 1, 1, 2, 3 up in 3, 1, 2, 3 up in 5. Now, it's also possible that this is a correction and that we still have another leg up. But this is a very good example of what a diagonal triangle should look like, with 3-wave patterns in each of the 5 legs up, and in particularly in the up legs in the pattern. At any rate, I tend to favor that this is actually a 4th wave that we've just put in, because the previous decline did not actually hit the bottom of the wedge. And as I've noted before, that 1280 area or just above it, that's where the longer term wedge trend lines come in. So I'm still looking for higher prices. However, I would be alert here if we get a corrective rally that fails, or if we start breaking solidly below this trend line. It's possible this is an important top in gold. So I tend to be looking at the bearish side here, even if I expect somewhat higher prices in the weeks ahead. And here is that bigger picture, and you can see those trend lines still overhead. Now again, if we break through here, let's take a look at the short side. Now, very interesting chart to my way of thinking, the British pound. I don't normally trade the pound or watch it, but it has been brought to my attention. And currencies tend to have unorganized, messy Elliott wave patterns because they trade 24 hours a day, and you've got spotty volume, you know, at various times overnight in various time zones and so on. But I think this best counts as an impulse 5-wave pattern up. And then obviously this would be a correction down. And note that around this 153 area, that is a 38% retracement, and that's also the area of the previous 4th wave. So this is an area you might expect support to come into if indeed this decline is corrective. Now, I think this decline counts best as a corrective pattern, A down, a triangle B wave, and then interestingly again, we have a very good example of a diagonal triangle. 1, 2, 3, 1, 1, 2, 3 for 3, and 1, 2, 3 for 5. We've broken above that that trend line, although as I speak we're down to about 153.46. Now, if this low can hold, what I've got labeled here as wave 5 of point C, then this is a very interesting trade, because more than likely, again, if we have equivalent legs up, if this is just an A wave up, you're looking at about an 18-point rally from where this bottoms. If we have equivalent magnitude rallies from this level, that would take us up to about 170. And so you have a situation where you have relatively low risk here. Now, if we go through this low, all bets are off. However, if we hold and start to rally back above, say, the 155 level, I would look for this market to head substantially higher, and it could do so in a hurry. So certainly worth watching. And finally, here's crude oil. And if you remember a while back, I was bearish on this ABC pattern. I think that this decline best counts as an impulse to the downside, and so far the rally back up best counts as a corrective structure as well. We've got a gap up there around the 78.50 level. Additionally, that's a 62% retracement of the recent decline, and also a parallel trend line to this corrective pattern also comes in around the 78.40 level. So worth watching. If the market blows right through there, obviously I'm wrong, but if you were to get a failure in that area, it could lead to yet another round of new lows for crude oil. And seasonally, with summer driving season done, that's a very real possibility that demand for crude and gasoline is going to go down into the winter months. Anyway, thanks so much for watching. Have a great weekend if I don't talk to you. Bye-bye.